The credit climate in India, like many developing regions, poses many challenges to building a sound credit infrastructure. With many borrowers scattered across the rural landscape, monitoring costs are high. Few creditors are able to front the administrative costs of tracking down clients for repayment. Consequently, many poor Indian residents experience limited access to credit. The market was previously characterized by a lender monopoly where borrowers were forced to depend on a single lender for loans and agricultural inputs. Additionally, the temporal nature of agriculture requires larger loans in the planting season. The cyclical patterns of borrowing force clients to smooth consumption during market shocks, which compromises crop yields and future income. With limited collateral to reduce loan risks, India was an unattractive site for commercial lending firms. In the 1970s, Muhammad Yunus enacted on this call to action and founded the Grameen Bank of Bangladesh, innovating a new method for extending credit to impoverished households. Borrowers form groups and apply for loans. Interest rates rank around 20 to 30% to cover the administrative costs of collecting repayments. Lenders hold weekly meetings where borrowers are summoned to pay installments on loans. Microfinance loans are limited liability, so borrowers are not required to provide collateral. Generally, borrowers are combined through assortative matching. Safer borrowers will group together while risky borrowers are forced to unite, reducing problems of asymmetric information. Under group lending, microfinance institutions are able to charge lower interest rates since risky borrowers are held accountable for the default of their fellow group member. They reduce the risk borne by the microcreditor and pay a higher implicit interest rate. Group lending addresses the issues of moral hazard, credit rationing, and selection bias. This system reduces the riskiness of individual borrowers and diffuses the risk across all community members involved. In India, repayment rates with the microfinance institutions are higher than through commercial finance lenders.
ওটা ভালো শুইতে পাইলে খুব ভালো জিনিস শুইতে পাইলে খুবই ভালো আর না শুইতে পাইলে খারাপ তা ভুল হয়েছে আমি জানছি যে আমি শুইতে পারছি না তাতে আমি কি করে শুই দেব চিন্তা হচ্ছে যে শুই থেকে দেখতে রাতে ঘুম হয় না ওই চিন্তাতে
Once upon a time, in 2008, the economy was turned upside down. The job market crashed, credit constrained, and house values plummeted, all from the mystical wonders of animal spirits.
And what did the Fed and Papa Bernanke do?
During a time of unbridled joy and consumer confidence, Mr. Bernanke decided to lower the interest rates.
Come gather round, people, wherever you roam, and admit that the waters around you have grown, and accept it that soon you'll be drenched to the bone. If your time to you is worth saving, then you better start swimming or you'll sink like a stone.
The Federal Open Market Committee took a trip to the open market operations to buy some bonds. Buying the bonds increased the amount of money circulating throughout the economy. The lower interest rates made hopeful homeowners scurry to the bank to get a mortgage. Safe and risky borrowers alike all wanted to purchase a home. Money-hungry bankers were blinded by green cash flows and began to loan mortgages to subprime borrowers. During this time, banks that amassed massive loans bundled the high-risk loans into mortgage-backed securities. The securitized loans were then sold to other banks and institutions, creating a chain of liability. The housing bubble grew and grew until it popped.
I've got a feeling deep inside, oh yeah. Oh yeah, that's right. I've got a feeling.
The other day, my dad went into Bank of America, where he's CEO. When he got home from work, he told me he had to start taking people's houses. I hope he doesn't take my tree house this year.
Since house prices reached historical highs when homeowners received mortgages, when house prices fell, many held more debt than the actual value of their home. The risky borrowers began to default one by one. Banks repossessed their homes as collateral. The series of foreclosures lowered housing prices even further. The economy was doomed. The collapse of the housing market was followed by a massive banking crisis. Banking on a steady rise in house prices, mortgage-backed security owners were shocked when the bubble burst and were forced to file bankruptcy. The stock market followed with unprecedented volatility. Animal spirits seeped their way into the minds of broken consumers. Mr. Bernanke lowered the interest rates even more to stimulate consumer confidence, but to no avail. The liquidity trap was just another symptom plaguing the U.S. economy. The days of uninhibited consumption were over, and the whole world suffered. As we discussed in our tragic tale, the purchase of bonds by the Financial Open Market Committee causes a fall in the Fed funds rate through an increase in the money supply. The LM curve shifts to the right, indicating that for a given price level, the real money balance increases as well as total output. The lowered interest rate creates a higher money demand by investors that want to borrow more cheaply. The process continues until the marginal reductions in the interest rate generated by monetary policy create diminishing rates of increase in output, forcing the economy into a liquidity trap.
Good afternoon, students. Today we're going to have a lecture with me, Mr. Hyman Minsky, on understanding borrowers, especially in relation to our current financial crisis. I will take you through the three stages of borrowers, or as I like to say, the three stooges. And here we have Larry, Moe, and Curly. Now I'll move on to what those three types of borrowers are. We have the hedge borrower, or as I like to call the safe borrower. They can and will use their investment to repay both the principal and the interest on the loans. Moving on then, we have the speculative borrower. Getting riskier here. They'll use the investment returns to cover the interest, but not the principal, which they will roll over. As you can see, we're getting riskier and riskier. And finally, we have the Ponzi borrower. They think that the rising value of their asset will enable them to refinance their debt. This fails, and the borrower fails to repay both principal and interest. And here we have my friends Larry, Moe, and Curly again. Moving on, now I would like to describe how I foresaw the crisis, both in America and possibly the current crisis in India. Lenders became increasingly aggressive, and this was because they were insulated from the risk. In America, the banks securitized their loans, moving the risk elsewhere and allowing them to take on riskier borrowers. So, similar phenomenon occurred in India, where microfinance banks were increasingly for profit, taking on riskier borrowers. And as they kept up that "come on in, we're open" sign, they let in more and more people. And guess who made it in? Those risky Ponzi borrowers. Yes, that was exactly what I warned of, mind you. And here you can see, people now are wondering, how did I know this? But it all goes back to those aggressive lenders and letting more and more people in. Now what do we have? Default, 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 and delinquent borrowers, and the mess we're in. Thank you very much, students. I hope you've learned something today. Howdy, folks. Today I'd like to talk to you about securitization in both the United States and in India. In the United States we got mortgages, and in India they have microcredit. I'd like to talk about the growth of securitization to start us out here. In the U.S., it started with those folks over at Citibank in 1991, issuing auto loan receivables. Between 1996 and 2004, it's grown at 19%. We got Freddie Mae and Fannie Mac as the two largest securities. And that's not the chocolate I'm talking about. Get your mind off the candies now. Moving on to India, we have the International Finance Corporation, a branch of the IMF. And with them, between 2004 and 2007, we had a 55% increase in loanable funds. I'd like to concentrate, though, on the ICICI, Industrial Credit and Investment Corporation of India, 42% market share between 2004 and 2005. And now I'll hand the microphone back over to my colleague, Hyman Minsky, who will lead you through the rest of this. Moving on, we have what is securitization. It's where lenders pool their loan assets together, and after doing so, they offer these packages as marketable securities, meaning they offer them to other investors. There you can see my old friend diving into the pool of money. Why do the lenders securitize, though? Well, first of all, it helps free up their balance sheet by removing assets. If you kind of picture that left-to-right T-shaped graph, it helps with the asset side, which in turn helps them
provide access to liquidity, and raise money at a relatively low cost because it has collateral already. And through this, we have more profitability. At this point, you're probably asking, how does securitization relate to the crisis? Well, in India, the ICICI uses an Indian rating agency to rate the customer assets, much like in the US, with Moody's and Standard & Poor's. And after these rating agencies, we see further parallels between India and the United States. India, the rise in delinquency rates from 1.2 to 3%, just over 3 years. And the use of microfinance loans for consumption rather than investment echoes eerie sentiments of the US subprime crisis and the high default rate. And with those high default rates in the United States, we had foreclosures and troubled banks that led the United States into a financial crisis. And in India, we have the high default rates, and we have large banks starting to close, which makes some people think we may be headed for a financial crisis.
The securitization of microfinance loans, heightened delinquency rates, use of loans for consumption rather than investment, aggressive lending to risky borrowers, and irresponsible credit rating agencies could culminate in a banking crisis and have further implications for the global institutions possessing the securitized loans. While the microfinance credit market accounts for a small fraction of the global economy, the exponentially increasing numbers taking out small loans could have grave consequences for the future stability of microfinance.